Hello, it's Peter Wright and Kathleen Beauvais in Ontario, Canada, with another episode of The Yakking Show. This is a show that brings you actionable business tips and ideas to improve your business. We do that by bringing you interesting guests. Today, certainly no exception. But first, let's introduce co host Kathleen. Hi, Kathleen.
Hi, Peter. Thank you so much. And thank you also very much for tuning in. Today, we do have a very special guest with us. His name is DC Palter. And DC founded, hello, DC, how are you?
Hi, Kathleen and Peter. Thanks for having me on today.
DC has founded two successful startups. He's an experienced B2B startup leader and marketing specialist focused on clean tech and sustainability. And today, he will be yakking with us about starting a business and pitching it to investors. So again, once again, welcome, DC. And for our audience, can you give us a little bit about your background and of course, tell us about your personal experience building two successful startup companies.
All right, sounds great. So anyone who looks at my LinkedIn profile gets very confused. It's been a journey, and it's been a long journey. I've done a few different things over that journey. But I started off as an energy engineer because I wanted to get involved in climate tech and solving energy problems. And I ended up working in well, nobody cared about that in the 80s. So the
Right.
jobs were in the defense industry, designing missiles, which was kind of the opposite of what instead of helping humanity, I was blowing it up. So didn't enjoy that too much. Ended up moving to Japan and working on pollution reduction in steel production. And so that was interesting. Did that for a few years. And then said, well, enough of the engineering. I like engineering, I like science, but I don't want to be doing it all day long. So I said, yeah, what I want to do is be on the business side of technology. So I went back, got my MBA. It was the mid 90s, and still there were no jobs in climate tech. And I ended up joining a startup in IT. I mean, this was the dot-com bubble. Everyone was
Mhm,
in
mhm.
computers, networking, and building websites and all that stuff, and that's where all the jobs were. And and I joined a startup, and I didn't intend to join a startup. That wasn't my goal in life, but I joined a startup, and it was like, wow, this is where I belong. This is what I enjoy. This makes sense to me. I never want to work in another big company again. So I joined the startup, ended up kind of restructuring the startup. And it took a while, but we ended up with a great product and ended up getting acquired by one of our um, partners that got acquired by another company, got acquired by another company that is now part of Broadcom. This is the way Silicon Valley works. And another way Silicon Valley works is when one company gets acquired, the people who don't want to work at a big company end up leaving and starting new startups. So that's what I
Mhm.
did. Create another startup in the same space, IT,
Oh.
test equipment. Um, did that for about 10 years. Was successful in building that into a good profitable business. Got to a point in my life where I said, that's I really want to be back in working on climate solutions. So sold that business and started looking for opportunities in climate. But now I'm kind of an older guy, and there was a I tried a couple of startups, didn't really work out. Ended up that where I found that I could actually help people a lot more wasn't building a startup myself, but was investing in startups that were already, that already had founders that were already going out to market, and then being mentors to them to really kind of help them go from product idea to business to a good investment. So I've made a transition from being the guy who ran the business to the person who is investing in. I've invested in something like 100 startups at this point, and then being a mentor to the startups. But what I see is, especially when we work with very, very early stage startups and entrepreneurs, many of them are very young. They have the same mistakes. They have the same misunderstandings. They kind of, especially in the same space, they have a lot of the same issues. And so instead of just working on a one-on-one, I started writing down uh, kind of what I was seeing, what people needed to know, and put together. I do a weekly column that I put up And now it gets something like some of my articles got up to like 20,000 reads. So I found that, yeah, it wasn't what I put it up just so that the people who were asking me questions, I could, instead of like trying to think of my feet, I could actually say, here, I've written down the answers for you in kind of a little bit more detail. Here you can go read the details and start putting together the whole series. And it really took off. And so I now have a lot of readers for these articles. And writing has always been something I've been interested in. So that kind of led me into, well, maybe hopefully I have a chance to talk about this later, but a novel about startups as well. So doing a little bit of everything right now, but staying kind of like, how do we build startups? How do we make startups? How do we make them successful?
Wow, that is an interesting journey, certainly.
It's been a journey, absolutely.
Yeah. Wow, good stuff. So here's one for you. In the current climate, this is a two-part question, but the two parts are attached for a reason. In the current climate, is it becoming a lot more difficult for startups to attract investment and finance their startups? Point one.
Mm-hmm.
And now on the other side of that coin, as an investor and an angel investor and someone who puts investment packages together, what is the most important factor you look for when you start advising people to invest, or you invest yourself in a startup?
Yeah, so those are both really great questions, and one that investors have been asking themselves. So pretty much any investor group meeting you go to, everyone is like, well, what are you seeing right now? Because we read the news, we see the Silicon Valley Bank explosion, we hear what's happening in the stock market, but it's hard to tell what's going on in our space, which is very, very early stage. So we all talk to each other, try to piece together the information. Certainly, the later stage startups are looking to go public. They need more. They can't go public now because the stock market's gone down. They need more money. The people who are writing checks for $100 million are being more discerning. So some of them are not going to succeed. Some of them are kind of like doing layoffs. But how does that affect the entrepreneur who's trying to raise $1 million and he's got a team of like 3 or 4 people? That's hard to tell. This answer is going to be a little bit long, but let me give you some anecdotal information from my network. So I'm in an investment group called Tech Coast Angels, and it's our chapter has about 150 members. We invest individually, but we also have our own member fund. We started the member fund 3 years ago. We raised $1 million among the members. It was designed to be an annual fund. We did 10. I'm going to make it simpler. It's not exactly accurate, but just to simplify things, we did 10 investments over the course of a year of $100,000 each, used up the $100,000. And then 2021, we created the second fund. The second fund was $2 million. And over the course of a year, we did 10 investments invested in 10 companies. Most of them were at 200K. Suddenly, everyone was piling into angel investing. There was all this money coming in. Everybody wanted to invest in startups. It went a little bit crazy. So our last year's fund, 2022, we had $3 million to invest in 10 companies at $300,000 each. But during the course of the year, the investment climate dropped off. Not all the founders got the memo. And so before we were, the valuations were a little bit high, the traction wasn't there, but that was the terms of the deal, so we would invest. And over the course of last year, we got more discerning. We're like, okay, that's an interesting startup, but your valuation's too high. And the founder's like, no, I'm not lowering my valuation. We're like, well, we're not investing. So we are still on our 2022 fund. We're now coming up on the end of April. I think there is room for one investment left, and then we'll open up our 2023 fund. So if you want to compare us to last year, you could say the number of investments we've done is down by about a third, I guess, is probably a way of looking at it. But we also had $3 million to invest instead of $2 million. So it's roughly a wash in terms of how much we invested. If you compare it to pre-pandemic, we're still much higher. And I think that is about right. That fits into what I've heard other places, that valuations are going back to where they were pre-pandemic, which is already a lot higher than when I started 10 years before that. The amount of money out there is still fairly large, but it's down by about a third from last year. So you could say it's down by a third, or you could say it's up like 50% over the year before. And I think that's about right.
Okay. So I got to ask you. Sorry.
Yeah, the second part of the question, which is, I can give a shorter answer for that. What are the hot spaces right now? Climate tech. If you are in climate tech, there's a bubble. You just put on your first slide, this is how much carbon dioxide we're going to save, and people are throwing money at you. Valuations are high. There's a lot of funds that have just been put together to invest in climate tech, and they need to invest. Everyone understands it's a very early stage, so they're not requiring the sort of traction that a non-climate tech would. So climate tech is hot. And the other one that's just been hot for 10 years is life sciences, pharmaceuticals, med tech, which is kind of a whole different world. You don't actually, everything else in the world I know, you need, when you're doing a business plan, when you're doing a pitch deck, you need to show how you're going to get from your idea to a product, to a successful business, to to $100 million in revenue, to your $1 billion exit. Life sciences, you can, all you need to do is show that we're going to get FDA approval, and then Pfizer or Merck or somebody else or Cardinal Health or Medtronic is going to buy it out for $1 billion. All you need is it's just strictly about the science, because once the product is proven, you will get bought out. You don't need to build the business. You don't need to you'll never have any revenues. So it's a bit of a different pitch, but it's also a different world. I can't look at it, and I can look at a pitch and say that sounds like a great idea, but I have no way to assess it.
Right. I got to ask you a quick follow-up now, having given us that background. Over the 10 years you've been doing this, and particularly over the last 3, when you've been putting a fund together with other people, has your success rate improved dramatically, stayed the same? In other words,
really hard to tell, because you don't find out if you're successful for about 10 years.
Okay.
That's kind of the challenge of early stage investing is you put money in and you get nothing out. It's not like investing in regular stocks or real estate or even racehorses. No dividends, no interest. No, you can't take your money out until the company is acquired, does an IPO. And that is long in the future. So there's something called a J curve, which is it's because your portfolio goes like this. You start with, say, $1 million in your portfolio. You invest it all over 2 to 3 years. You're down to zero. Your failures come quick.
Yes.
The ones that don't work, they die, and you get really depressed. You're like, I just lost $1 million. And then the ones that do succeed, they take longer. And the small successes come next. And then the big successes take 10 years. So you never know until you're 10 to 12 years out whether you've been successful or not.
Right. But if you can stay in the 10 to 12 years and your successors are bringing home the bacon now, then you start seeing that curve go the other way, right?
Well, that's the idea, is somewhere around the 5 to 6 year mark, you should pass your break even, and then it should skyrocket when you get the really big exits. And one thing anyone in early stage investing will tell you is your entire portfolio of 10 to 20 companies, your success will be determined by one of them. So about half of them will die completely. The other 40% will return 1x, maybe 2x. So you kind of 90% of your portfolio, you break even.
Right.
And then you end up with one company that has 100 times return and kind of makes up for everything. And you never know when that's going to come and which one it's going to be. So you really don't know until 10 years. Whether that's going to be a 10x return or 100x return or what. So
it's a pretty big gamble as an investor.
It's exciting. What's that?
That's a pretty big gamble as an investor, isn't it?
Yes. Oh, it's huge. So do not, if you're thinking of becoming an angel investor, my advice is do not put more money in than you can afford to lose.
Or to lose, right? For sure.
You're not going to get it back for 10 years. So you just have to like write it off and say it's not there. And then when it comes in, it's great. So yes, for your retirement fund, stick with bonds, with Netflix stock, with S&P index funds, and then this is
right.
in a way almost like building another business, and it might be successful. Hopefully, it'll be successful, but no guarantees and nothing you can do about it until 10 years from now.
Right. So this is something I wanted to ask you, DC, because on your website, you have a blog post that's entitled Why Startups Should Have Both a Builder and a Visionary. And I'd like for you to explain that, please.
Okay. So I get a lot of people pitching me, and I've been through this myself as a founder. You tend to get two types. You get the visionary who's got wonderful ideas, sees the future, knows everything, but just can't focus on the day-to-day. And ideas are wonderful, but they are worth nothing. And then you get the guys, and it's a lot more like me. We call them the plumbers and the architects, right? So the visionary and the I forgot what term I used, but the builders, who's really good with the day-to-day, but not coming up with brilliant ideas. And what you need is the companies that are really successful tend to be two founders, where one of them is the vision person who can go out, can tell a story, can talk to investors, can talk to customers, can sell everything, can come up with the new ideas. But then you also need the founder who can put those ideas into practice and deal with the day-to-day and the accounting and keeping the company running and get the product working and dealing with customer support and all those things that actually really, really, really matter that the visionaries don't think about. So I always look for both the CEO and the president, or whatever roles they want to take, but having both somebody who's an ideas person and a details person.
Okay, makes sense. Yeah. So let's talk about your book. DC, you've written a book which is called To Kill a Unicorn.
Everywhere.
There you go.
Kill a unicorn. That's right.
So tell our audience two things: the background, how you came to write it, and how you actually did write it, because that's a whole story on its own, and what's in the book.
Okay, so I'll start with what's in the book. It is a story about startup. It's a story about a Silicon Valley startup that has some incredible technology that's going to revolutionize our entire transportation industry. No more cars, no more highways, no more airplanes. They have a solution for all of this, instant transportation. It is great. Comes out of some PhD research at a university, major university in Silicon Valley. But right now, the chief scientist is missing. That's kind of the beginning of the story. And his friend, who's a hacker, has to try to find him. And what he starts to realize is there's two possibilities here. One is it's either a total scam, like Theranos. Actually, Theranos didn't start as a scam. It just turned into one, which this one may have as well, that they're just collecting money. And it kind of looks like it might be a real estate scam. They're taking the money and investing in real estate. And then the founder's just going to use that for her personal wealth and kind of ripping off investors to make herself rich. That's one possibility. The other possibility is something really sinister is going on here. And the company is very mysterious about everything going on inside the company. So the hacker has to try to figure out what is going on. And I think, to me, the most interesting part about it is, so it's written from the hacker's point of view. He's a Japanese American. He has a lot of his own personal challenges with, he's young, he's a little bit of an alcoholic, he had problems with his parents, but he's a good person. He wants to try to find his friend. But he is your very typical engineer, programmer, hacker type. He's very comfortable in front of the computer. He's not good at dealing with everything outside of the computer. And to try to solve this mystery, he realizes he just hacking alone doesn't only gets him so far, and he has to go out and start actually talking to people, and that's outside his comfort zone. So that's really the story of how he goes about finding out what's happening inside this mysterious startup called Super Duper that's already raised $1 billion in venture capital from the Bitcoin billionaires who are financing it, and the VCs. So it's a bit of a farce about Silicon Valley. It's got a little bit of science fiction in there. It's structured as a noir mystery, and it's even got a little bit of manga. So it's a big mashup of everything. I try to make it as fun as possible. I tell people this is the most fun you will ever have reading about a Silicon Valley startup. A whole lot more fun than the lean startup and accounting books, and you can. But yeah, it's designed to be a bit of a farce about all the just insanity of Silicon Valley. And a good portion of it is based on Theranos, if you know what happened there. Because that was just I had already started writing it and was trying to figure out, well, how would she actually get away with this? And then Theranos broke. It's like, that's how she did it, and that became the model for how to get from ripping off a few investors to turning it into $1 billion scam.
Oh, I like this. I like this novel already.
You
get a copy.
Definitely gonna have to read. You're gonna have to read this one, that's for sure. So, did you want to be an author, or did you think, well, I've got all these stories and experience I've accumulated over many years, why don't I put it into a book? How did you go about getting it from an idea into a book form?
So I've always enjoyed writing. I love reading, and back in my high school, college days, I had to make a choice. Did I want to be a writer, or did I want to be an engineer? And
right.
Pretty much everybody told me, stick with the day job, do the engineering, do the writing for fun. And that's what I did, but I always missed the writing. So I've always written short stories. I've been involved in a lot of book groups, but never had the time to write a novel. So when I sold my last business, I suddenly had more time. It's like, okay, what am I going to do now? I'm either going to found another startup, or along with angel investing and mentoring, I needed a little bit of a break. So I started writing at the same time, and I've always, so I mean, that was the other aspect of in my working life, I found myself being drawn towards the marketing side of technology. So, which was really about understanding your audience, trying to write something that the audience understands. That audience may be a technical audience, getting them to understand the product you're making, but also understanding what the customers are telling the engineers. So there was always a lot of writing and translating involved. So I said, okay, now I actually, want to write a novel about life in Silicon Valley. So I started on that. It took me 5 years because so anyone who's thinking about writing something, this is obvious. If you want to write a mystery, you write it from the end and you put together an outline and you make it like a puzzle. I don't write that way. I can't write that way. So I wrote it from the beginning. I created the characters, I set them in motion, and I ended up with a story that didn't work. Great characters, interesting situation, but it just didn't work. So threw it away and started over again, version 2. Spent like half a year on that, and I got further, but I still hit a dead end. Didn't work. Threw it away. Started over again. 4th version. The pieces came together and actually stopped after version 3. I studied some movies. I studied Chinatown. I looked at the plot structure. I said, okay, now I'm going to try again. And that one actually, all the pieces, I had so many different pieces I could put together that actually fit together very well. And then another year of editing afterwards. So, writing a novel is it takes longer than building a startup, and you get paid a whole lot worse for it. So,
so just getting back to startups, DC, can you explain, for the benefit of our audience that may not be aware, can you explain what a startup accelerator is and why an entrepreneur might want to join one?
Sure. So kind of the big names in accelerators, and Y Combinator, everybody knows Y Combinator as
Yep.
kind of the granddaddy of the accelerators, and they get like every cohort, which is twice a year, they have 300 companies that come in, they go through their education program with the idea of putting together their business plan and their pitch deck and their outreach to investors so that they are ready to build the business and get investment. There are a lot of accelerators that start at an earlier stage, like I'm a mentor at UCLA and USC universities, where these are typically college students or grad students who have a good idea, but they don't know how to put together the business. So there, it's even earlier stage of, okay, well, what does the business need to be? What type of business are you? What does the market look like? What is the business model canvas? Becomes very educational in entrepreneurship, working with people who've done it before. And then there are some very specialized accelerators that are, for example, Techstars in LA has an accelerator just for life sciences, health tech startups that they do in collaboration with Cedars-Sinai Hospital. And so they're very specialized. They have mentors who are doctors, hospital administrators, medical people, and then they bring in the investors and the mentors who know that space very well. So there's kind of a range, but the idea is either from very early stage up to what we call Series A, where you're already selling a product and have significant revenues. This is giving you assistance in putting together the business, putting together the pitch, putting together the pitch deck, talking to investors, and how to find investors and how to talk to them. So they're very useful if you need it. Mm-hmm. They're also most of them are very expensive. Some of them, like the universities, they don't charge for it, or they may just be for the students. The ones like Y Combinator, they give you money, so that's a good way to get investment, but they also take a large chunk of your equity. So it can be very, very expensive. But so I always tell people there's some that are really useful. The ones that are specialized in your field are going to give you connections to people, customers, investors that you need. Those are great. Ones that don't charge anything, sure, why not? They can give you some assistance, and they can be great. But then there's also there's a whole world of accelerators that are promising a lot but don't deliver very much. So you really need to think through as an entrepreneur whether what you're going to get out of it is worth what you're going to pay for it.
Pay for it. Sure. So I got to ask you a question about clean tech that it's been bubbling around the back of my mind ever since we've been talking. Well, for a long time, and you're the first guy that I think is qualified to give me an answer on this one. So electric vehicles are all the buzz, right? And yes. I see significant disadvantages because of the effect on the environment of mining cobalt and lithium in places like Democratic Republic of Congo, and how do you dispose of those batteries? And to my practical mind, it doesn't make sense to cart around several hundred pounds or kilos of dead weight in the form of batteries. So we've had technology to transfer electricity from overhead wires or even perhaps rails to vehicles for 100 years. Why are we not seeing any developments on running cars without batteries, or with very small batteries just when they get off the main grid, sucking their power either out of the road or out of something else? Because we have the technology to do that, surely.
That's a really good question. And I think that's more of a policy question than it is a technology question, because you're right. Okay. The technology could be done either way. We've started to see things like buses at the bus stops having wireless charging. So as they pull up to the bus stops and they sit there for a minute, then they can charge the battery, and that way they can have a much smaller battery. Right. We also see things like fuel cells was going to be the savior instead of electric lithium-ion batteries. But what we have right now are lithium-ion batteries, and it works, and Tesla has proven the business model, and everyone's kind of piled in that. If we wanted to have underground or overhead electrical charging that way, that would take a government investing trillions of dollars that the government hasn't, at least certainly the U.S. government is not up for. And so it's much easier to promote what's there, which are
Sure.
Electric vehicles. I agree with you completely. This is anathema in the clean tech space, but whether electric vehicles are actually environmentally friendly or not, it depends on the details. It
Oh, I
depends on where
agree.
your electricity is coming from. It depends on
Absolutely.
how much, so Tesla is still a big, heavy car carrying around way too many batteries. I would be so this is the thing that kills me is I don't know about the rest of the world, but Americans have range anxiety, right? They feel like they have to have 300, 400 miles of capacity in their vehicle, and then they have to be able to charge wherever they go. And, maybe twice a year, I drive somewhere that's more than 400 miles away. Most of the time, I'm driving around the neighborhood. Um, Especially here where we have two cars anyway, why not have one car that has a 100-mile range and then have a very fuel efficient hybrid that can go anywhere that would give you the longer range. But that's just not the way Americans think. So it's kind of frustrating. And
Sure.
yeah, the I have a Tesla, so I'm more green than you crowd out there. I'm probably making a lot of enemies right now, but they do drive me crazy.
Oh, me too. Me too.
Yeah.
Sorry, Kathleen, back to you.
Peter, we're running a little short
I
on
know.
time, so I know you have a burning question you'd like to ask DC, though. So why don't you go for it?
Okay, so DC, here's my burning question, and you're the best guy to ask this question. We ask it of all our successful guests. It's something that over my long lifetime has puzzled me immensely. The question is, in your experience dealing with all the people, successful mainly, but some obviously unsuccessful, you've come across, is there one characteristic or mindset or even a habit that differentiates those who become successful from those who remain average or fail? And I don't just mean accumulating wealth. I mean having a good life in addition to having a good income. Is there one thing or is it more complicated?
Wow, what a question. I don't have a good answer. I think it is complicated. I don't think there is one thing. I think your question actually has two pieces of, what makes a successful entrepreneur versus what actually makes a successful person.
Sure.
And they are often very different things. A
Yes.
lot of the successful entrepreneurs are, I won't use expletives here, but you can imagine what I would say. And
Right.
that's one of the reasons they're successful, because running a startup is not an easy job, and it's a lot of cat herding, and it does sometimes take a personality that means not always being nice. But when I think about the companies that the founders I've met that have been successful and the ones that haven't been successful, certainly having experience and having emotional, I'll leave out the emotional IQ because some of them have been real expletives. I'd say the one thing for a startup founder that makes the most difference is enjoying doing everything. And that's kind of the difference of a startup founder from even somebody who joins a startup after they're at 20 people or, a big company. You have, as a founder, you have to do everything. You have to, if you're a leader of a big company, you're a manager. That's all you're doing all day is managing people. They're the ones but a startup, you have to build the product. You have to do support for the product. But you also have to think of the product, and you have to sell the product. So you have to do sales, you have to do marketing, you have to do product design, you have to do customer support, you have to pay the bills, you have to do the accounting, you have to make the coffee. You get to do everything from the littlest things to the biggest things. And that is a different mindset from people who've worked in kind of a corporate job where you get very specialized and very good at one specific thing. So you really have to enjoy doing everything and doing everything all day. And nothing is too small, but also like not letting the details tie you down.
Right.
When it comes to actually being a successful person, that is a bigger conversation that has nothing to do with money. For me, it's just about being satisfied with life, being satisfied with your partner, finding the good in things, and money helps, but it not having enough is a problem. Having too much doesn't. You reach a saturation level pretty low, where then it's just a matter of, are you going to enjoy life or not?
Right.
Mm-hmm. No, thank you. Very good. Very good
Yes.
answer.
So DC, how do people contact you?
Well, probably the best thing is if you're on LinkedIn, and pretty much everyone I know is on LinkedIn. Follow me there. It's DC Palter on LinkedIn, and you can reach out to me there with messaging, and that's usually the better than emails or other ways. I'm on Twitter as well, a little bit less so. It's not as good a forum for business people. And then I have two websites, just to confuse people. I have my Pitching Angels, so it's pitchingangels.com. That's where I have all of my materials, my startup articles, my advice about what your pitch deck should look like. That's all up on pitchingangels.com. And then there's a feedback page there where you can contact me. And then for the book, I have dcpalter.com, where you can read about the book, and then it also has a contact form on there. So lots of ways to get hold of me.
Wonderful.
Okay.
Thank you.
That's all there. And for our audio listeners, all that information will be in the description for you to pick up. And just to confirm, people can order your book direct from your DC Palter website?
That would just have a link to Amazon. So the best thing to do is go to Amazon and look up To Kill a Unicorn, DC Palter.
Okay.
And you can be, that works in Canada, works in Germany, works in Japan, Australia. So that's the best way to buy the book.
Excellent.
Great. Thank you very much for that.
Absolutely.
And back to Kathleen to round it off.
Great. Thank you so much, DC. It was a pleasure having you on the show today. And thank you, everyone, for tuning in. If anyone is interested in being a guest on our show, all you need to do is please go to the yakkingshow.com, where you will find the contacts tab. All you need to do is click on that, where you will find a short application form, and we would love to hear from you. And please, if you have any topics you'd like us to cover, let us know. We have access to so many experts on this show. Until next time, take care, everyone. Bye-bye.
Goodbye.